Good morning. Welcome to the market opening bell on Wednesday, May 14th, 2025. After 8 consecutive trading days of gains up 1,577 points or 7.2%, the Hang Seng Index pulled back on Tuesday, dropping as much as 478 points to a low of 23,070. It closed down 441 points or 1.9% at 23,108. The Hang Seng China Enterprises Index fell 173 points or 2% to 8,386, while the Hang Seng Tech Index dropped 177 points or 3.3% to 5,269. Total market turnover decreased 31.8% from the previous day to 219.8 billion Hong Kong dollars. Southbound trading recorded a net inflow of 2.261 billion Hong Kong dollars compared to a net outflow of 18.528 billion Hong Kong dollars the previous day. Net inflows included Alibaba at $533 million, CNOOC at $353 million, and UB Tech at $253 million. Net outflows included Tencent at $664 million, SMIC at $227 million, and Xiaomi at $150 million. Mainland Chinese markets showed mixed performance at the close. The Shanghai Composite Index rose 5 points or 0.2% to 3,374, while the Shenzhen Component Index fell 13 points or 0.1% to 10,288. Combined turnover in Shanghai and Shenzhen markets was 1.2915 trillion yuan, up 13.2 billion yuan from the previous day. The renminbi US dollar central parity rate was set at 7.1991, breaking above the 7.2 level, appreciating 75 basis points from the previous trading day and marking 2 consecutive days of gains, reaching a 1-month high since April 7th. The onshore RMB broke above 7.19, peaking at 7.1855. While the offshore RMB rose past 7.19 and 7.18, reaching 7.17962. This was driven by positive Sino-US trade talks, a declining US dollar index, and record high Mayday travel data. Technical analysis: the Hang Seng Index over 400-point drop on Tuesday is considered a normal correction after Monday's near 700-point surge. The 23,000 level is expected to provide support. If the correction continues, the next support level is the 50-day moving average at 22,800 with resistance at 23,500. JD Group Q1 revenue reached 301 billion yuan, up 15.8% year-on-year, exceeding expectations. Non-GAAP net profit attributable to shareholders was 12.758 billion yuan, up 43.4% year-on-year, also beating forecasts. JD Logistics reported revenue of 46.967 billion yuan, up 11.5% year-on-year. New business revenue, including food delivery, was 5.753 billion yuan, up 18.1% year-on-year. In its Q1 earnings call, JD stated that its food delivery business creates significant synergy with its core operations, with daily orders expected to soon exceed 20 million. JD Health reported Q1 revenue of 16.645 billion yuan, up 25.5% year-on-year, with non-IFRS profit of 1.768 billion yuan, up 47.7% year-on-year. Tencent Music Q1 total revenue was 7.36 billion yuan, up 8.7% year-on-year, with adjusted net profit of 2.23 billion yuan, up 22.8%. Online music service revenue grew 15.9% to 5.8 billion yuan, with paid music subscribers up 8.3% to 122.9 million. The average revenue per paying user, ARPU, increased from 10.6 yuan in Q1 2024 to 11.4 yuan. Samsonite Q1 net sales were $797 million, down 7.3% year-on-year, or 4.5% on a constant currency basis, impacted by declining sales in Asia, reduced consumer confidence in North America, and timing shifts in North American wholesale channel sales. Net profit was $48.2 million, down 42.6%, with earnings per share at 3.5 US cents. Gross profit was $473 million, down 8.9%, with a gross margin of 59.4%, down 1 percentage point, mainly due to changes in regional sales mix. Tencent and VTech will release results today. Tencent's Q1 revenue is expected to range between 175 billion yuan and 177.1 billion yuan, up 9.7% to 11% from last year's 159.5 billion yuan. Q1 non-IFRS net profit is projected to be between 58.1 billion yuan and 64 billion yuan, up 15.6% to 27.4% from 50.265 billion yuan last year. Investors will focus on Tencent's latest operational guidance, including the sustainability of gaming revenue growth, progress in ad-driven marketing services, fintech growth prospects, AI capital expenditure and outcomes, monetization strategies, shareholder returns, share buyback program, and long-term shareholder value maximization. U.S. stocks show mixed performance on Tuesday, dragged down by a sharp 17% plunge in United Health Group's share price. The Dow Jones Industrial Average fell 269 points or 0.6%, closing at 42,140. The Nasdaq rose 301 points or 1.6% to 19,010, while the S&P 500 gained 42 points or 0.7%, closing at 5,886. After a sharp decline in early April triggered by Trump's tariff policies, the S&P 500 recovered all losses in just 6 weeks, marking the fastest rebound since 1982. The Nasdaq Golden Dragon China Index, reflecting Chinese ADRs, dipped 5 points or 0.07% to 7,443, with Alibaba down 0.68%. NVIDIA announced an AI partnership with Saudi Arabia, supplying over 18,000 advanced AI chips to Saudi Arabia AI data centers. Its stock surged 5.6% to $129.93, making it the top performing Dow component. Other major tech stocks rose, with Tesla up 4.9%, Amazon up 1.3%, and Apple up 1%. Cryptocurrency exchange operator Coinbase, set to join the S&P 500 on May 19, soared 24%. During Trump's visit to Saudi Arabia, the kingdom pledged $600 billion in U.S. investments, while its sovereign wealth fund reportedly ordered 30 Boeing 737 aircraft, lifting Boeing shares by 2.5%. United Health CEO Andrew Whitty resigned for personal reasons and suspended full-year guidance, causing the stock to plummet 17.8%. U.S. April consumer price inflation fell to 2.3% year-on-year, the lowest since February 2021, down from 2.4% in March and below the expected 2.4%. Energy costs dropped 3.7%, exceeding March's 3.3% decline. Inflation for food 2.8% and transportation 2.5% also eased, while housing inflation 4% remained steady. Annual core inflation stayed at 2.8% as expected. Month-on-month, the consumer price index rose 0.2%, rebounding from March's 0.1% decline, but below the expected 0.3%. Core CPI increased 0.2% above March's 0.1%, but slightly below the expected 0.3%. With inflation cooling, Trump urged the Federal Reserve to cut interest rates, citing falling gasoline and grocery prices. He criticized Fed Chair Powell for delaying rate cuts, calling it unfair to the US and stating that rate cuts would be a beautiful thing. Our stock pick today is Pacific Basin Shipping, stock code 2343. Pacific Basin Shipping continued to expand its operating activities in the first quarter of this year, with improved profits compared to the same period last year. During the period, the daily average revenue for Handysize and Supramax dry bulk vessels based on time charter equivalent TCE rates was 10,940 US dollars and 12,210 US dollars respectively, representing year-on-year decreases of 1% and 10%. However, these figures outperformed the spot market indexes for Handysize and Supramax vessels by 2,940 US dollars and 4,310 US dollars respectively, primarily due to robust fleet contracting rates. For the second quarter, 77% of Handysize vessel days and 95% of Supramax vessel days have been contracted at average daily rates of 11,390 US dollars and 12,400 US dollars respectively. For the second half of 2025, 25% of Handysize vessel days and 37% of Supramax vessel days have been contracted at the average daily rates of 10,150 US dollars and 12,090 US dollars respectively. According to the Baltic Exchange, forward freight agreement (FFA) rates for the second half of 2025 are close to current spot market levels, with Handysize and Supramax FFAs for Q3 2025 at 9,110 US dollars and 9,130 per US dollars per day, respectively, and for Q4 2025 at $9,870 and $9,850 per day, respectively. The group adheres to a disciplined fleet renewal and growth strategy while maximizing optionality. In the first quarter, the group exercised purchase options at attractive prices for two long-term chartered Handysize vessels, one 40,000 deadweight ton built in 2020 and 138,000 deadweight ton built in 2018. It also took delivery of the final vessel in a series of four newly built 40,000 deadweight ton Handysize vessels under long-term charters constructed in Japan. Three 64,000 deadweight ton Ultramax vessels and one 42,000 deadweight ton Handysize vessel, all newly built and under long-term charters, are set to join the leased fleet, with two deliveries in 2025 and two in 2026. These vessels, built in Japan and equipped with scrubbers, come with options to extend leases at fixed rates and purchase at set prices. For the remainder of 2025, the group has the option to purchase two Handysize vessels and one Ultramax vessel, which will support fleet renewal at attractive prices. In Q1 2025, the group sold and delivered three smaller, older Handysize vessels, average age of 21 years, including all current sale and purchase commitments. The core fleet consists of 123 Handysize and Supramax vessels, including short-term chartered vessels in operations. The group currently operates a total of approximately 262 vessels. The group's financial position remains solid, and it will continue to pursue disciplined counter-cyclical investments to expand and modernize its fleet while selling older, less efficient vessels. Recommendation: buy at 1.75 Hong Kong dollars. Target $1.92. Stop loss at $1.65. I do not hold the above stock.